Well, at some point in the near future, y'all, we're going to have calls that are talking about other aspects of the market other than just interest rates. I'm looking forward to getting into a more normal cycle with regard to rates so that we can talk about some of the other stuff that has to do with what we do for a living. But until the Fed starts getting back into a normal range, these are going to be the predominant conversations of this video, this weekly video that we do. And we got quite a bit of news this week to talk about, so let's dive right in. Consumer Price Index, measuring where we were for the month of August, came in at expectations on the headline number, but below expectations with regard to the core number. Inflation was a little bit worse at the core level than we would have liked to see, especially going into a Fed meeting next week. And here's what's influencing the core rate. Housing was up 5.2% year over year, y'all. Car insurance up 16.5% year over year, and that's actually an improvement. We've been up as high as 23% increases in car insurance year over year, so that 16.5% increase is actually an improvement. But those two items in particular are making up an outweighted share of the Consumer Price Index. So y'all, there's not many folks nationally that are willing to stand up and explain what's causing those two components, housing cost and car insurance, to be higher than these reports are predicting. But obviously, when you look at the amount of illegal immigration that we've had in this country, we have a lot more folks that are looking for a roof over their head. A lot of those folks are not insurable, or at least not buying insurance, that is causing uninsured motorist protection in particular to be much more expensive. So there is a cost to having open borders. Trying not to be too political on this call, but that is just a financial fact that is weighing into what is affecting these numbers. I think when the Fed starts taking that into effect, that maybe they are moderating some of their predictions and their willingness to start easing in light of the explanation for why some of these numbers are more stubborn, especially with regard to housing and with insurance. In other words, I think they're weighting those things a little bit less and they're likely to start moving. The predictions. The CME Fed Watch tool that we've talked about several times on this call now has a 71% chance of the Fed moving a quarter of a point on the 18th. They have a 29% chance of the Fed moving a half. As we have explained numerous times on this call, the Fed does not fix mortgage rates. They do not fix long-term interest rates. What they do is establish a trading trend line or an environment in which fixed income securities are bought and sold. And to that extent, they're going to have an impact on mortgage rates when they start moving and they start setting that pace. As we have discussed, interest rates, y'all, are actually significantly improved. We are sitting right now, and this is the Mortgage News Daily Poll for a 30-year fixed rate conforming loans. Let's dive right into the current numbers. 6.15% today. You have to go back to January of 2023 to find rates at that level. So we are sitting at 18-month lows in interest rates, which is a nice place to be. A week ago, a little bit worse a week ago, so we're a little bit better today, an eighth of a point or so. We were at 6.27. And then 30 days ago, we were at 6.55. So y'all, we've improved about 3/8 of a point heading into this Fed meeting over the last 30 days. That's an important benchmark to remember because with the Fed likely only moving a quarter, we are likely to see some of the optimism that is now priced into the fixed income markets coming out after the Fed only moves a quarter. If they move a half, it's a different story. We may see a bit of further rate relief if they move a half. But if they only move a quarter at this point, well, the market's priced in improvement beyond that. So we may see a bit of a pullback unless we get minutes from that meeting that suggests they're going to be more aggressive at future meetings, which they may well give us. So there's a lot hanging on that meeting. There's a lot hanging on how the Fed is going to explain that meeting in their minutes to follow. So let's go back and see where we've been, y'all, at the top of this rate cycle that we're currently in and where we are today. So you have to go back to October 19th of 2023 was when I found the top rate of the current cycle at 8.03% for the national average. That's Mortgage News Daily. I just went back into their table and I looked for the highest number that I could find. That's where it was, October 19th, 2023. Today, being at 6.15%, a $400,000 mortgage in October of 2023 would have cost you $2,943 a month. Today, that same mortgage is $2,437 a month on a $400,000 balance. So we have improved $506 a month on a $400,000 mortgage. Another way of saying it is a $400,000 mortgage in October of 23 now buys you $483,000 for the same payment. So we've seen nice improvement, y'all. $83,000 in additional buying power in the last 18 months or 20 months or so is a nice improvement in rate. And again, looking at where the Fed is likely to be, and at least in this next meeting, we're not going to get improvement that justifies that much movement in the bond market. So we're likely to see rates pressure a little bit higher after the Fed meeting. It's going to be a lot to explain when buyers start calling when they see the headline announcement that the Fed's cutting rates. Explaining why those rates may not be improving at the mortgage level is what I'm trying to equip our audience with, because this call primarily goes out to real estate agents and real estate professionals and a few buyers that are interested in buying a house in the near future. So share it, get it out there. Let's get this messaging out there. Timing locks in this environment is extremely important, y'all. I would not float into this Fed meeting upcoming. I don't think we're going to see better pricing after the Fed moves. I think they're just going to meet expectations, if not disappoint a bit. So with that said, stay blessed, stay safe, have a great weekend, and we will talk to you next week.